undergraduate student kind of says, basically I can do what I want. And it kind of goes along too with the feeling that we can do hard things. Still warming up. And it wasn't until I was teaching Elders Quorum and there was a response by horses with me. It really caused me to think. And I'm hoping it'll come up here, but you know the poem, black is the pit from out of the night that covers me, black is the pit from pole to pole. I thank whatever gods may be for my uncomfortableness. Matters not how straight the gate, how charged with punishments the scroll. I am the master of the faith. I am the captain of the soul. And then when I read Orson Whitney's response, our thou truth, and what of him who bought thee with his blood, plunged into devouring seas and snatched thee from the flood. And there's like 4 other verses here. But the point I want to make here is the last part. Bend to the dust, that heaven-bowed small part of life's great whole, and see in him and him alone, the captain of the soul. And I know what William Henley was trying to do. He's trying to say we're active in the things that we do. But it's important that we realize, too, that really, truly, who is the captain? Okay, today what we're going to do is we're going to talk about insurance. I appreciate I have a guest speaker today. I'm just going to take the first couple of minutes, and then I'll turn the time over to Tyler. First thing, let's talk about our financial plan. You'll have 5 different sections. So in each of these sections, for example, you'll have life insurance. Do you need it? Do you have it? How much should you have? What type is it? What are your costs and coverage? What are discounts/specifics? You'll include a copy of your clue report. Anyone know what a clue report is? How many people don't have a clue report? So we'll actually be doing that. We'll talk about that on Wednesday. It's a comprehensive liability underwriting exchange. It's very similar to a credit report. But it's something you need to understand because if you're changing insurance carriers, they will pull that. Summary sheet of your health insurance coverage, which is the coverage. For example, you have BYU, it's like pages 2 and 3 on that summary sheet. It's online. If your family, what you need to do is know what kind of coverage you have. And also, Learning Tool 29, life insurance needs. It's 6 different ways on calculating how much life insurance. So Tyler doesn't have to calculate that for. And then your action plan on each of these. What insurance and coverages should you have? Okay, does that make sense? And you'll use the template there. Yeah.
So for our parents' insurance,
right? So you'll need to get that just a summary sheet, and usually you can go online, and it's just called a summary sheet. Okay, what are the things? What are the things we can do with risk? Risk, is it good or bad?
Yes.
Yes. I just wrote this little chart here. What are the things we can do with risk? Okay, mitigate it so we can reduce it. Give me an example of how you can reduce risk. How many people drove this morning? How many people put their seatbelt on? What's the purpose of the seatbelt? Reduce risk. What else can we do with it?
Accept it.
Okay, so you can assume it. I had a 1973 Pinto, I'm safe at every speed, at any speed. And I didn't have full coverage insurance. All I had was liability. So my roommate borrowed my car one day, and he went to the airport and picked up a friend. He goes, oh, by the way, someone backed into your car. And it's just like, so I had to assume that cost. What else can we do?
Transfer.
Okay, we can transfer it. How do we transfer risk? Just be your insurance contract. And what's the last thing we can do? We can avoid it. You cannot skydive. You cannot scuba dive. You can stay away from things like that. But the key is we just need to understand. Can you transfer all risks? So I've got term life insurance. So hopefully, it's hard to say some of us are worth more dead than alive. but hopefully we can transfer a lot more than just the financial costs of that. So yesterday I got to hang out with my grandsons, 2 grandsons, and it was really fun holding the 6-day-old one. And Logan and I had fun too, but hopefully I'm more than just the financial costs there too. What about the principles? You know, what we're trying to do here in this class is try to understand what are the principles of being a wise insurance consumer. Because that's what we want to be. We want to be wise stewards over the resources that we have. And part of it is using insurance, using it properly. What do you think? What are the principles of being a wise insurance consumer? Thoughts?
Maybe
Sure.
understanding your needs.
Understanding your needs. Why do you want insurance? And also, probably part of that is understanding which products can meet the needs the best. You have another, Nathan?
Yeah, I was going to say something similar, but just not getting not more than you, but not overpaying.
Yeah, not overpaying. Some of these insurance products can be very expensive. In fact, Tyler will talk about the difference between term and cash value insurance. And the difference, your premiums can be 10 to 20 times more. Other principles. Realize just because it's written in the book doesn't mean it's right. Clark.
I think some of it's like responsibility or maybe even honesty because
Yeah.
you know if you didn't have like good enough car insurance and you got in a wreck and then are you going to go bankrupt or you can't necessarily pay for some hospital bill.
Right? So you want to take you want to be wise. You want to take responsibility for your actions. Yeah.
Tag along to that, like the moral responsibility you have to your family.
Well, you know what? You're supposed to take care of our family. Is death an excuse for not taking care of your family? I don't think it is. At least in the environment that we're in now. One more thought? Here's just kind of some things that I thought. Know yourself and your goals. What do you want to accomplish? Your budget. It makes no sense to start an insurance program that you know you're not going to be able to fulfill. Understand in detail the tool of insurance, costs and benefits, especially those based on assumptions, i.e. cash value products. Read and understand the prospects and illustrations carefully. Again, do you want to insure against everything? Can you insure against everything?
Yeah.
No, you can't. Just be way too expensive. So only high cost, high severity items. Work with high quality individuals and institutions, and then you need to sit down once a year and review your insurance. I have a brother who's an insurance guy, but he hates to speak in front of classes. And he just called me up and he says, hey, when you did your housing insurance, we just saved you $1,500. And so I'm always happy at things like that, but you need to sit down and review because things change. So I know a lot about housing, buying home insurance and what the discount is for your security systems, all of these different things. So understanding those discounts is really important. Is there a relationship with your investment and your insurance plan?
Well, they both have to do with how much risk you're willing to bear.
Okay, they both have to do with how much risk you're willing to take.
You're taking a lot of risk in investments, but then you're also have a ton of insurance, and you kind of have a schizophrenic plan going on.
And notice, and this is just an example here. Here's a person, there's investments. You can say they get married somewhere after 25, but as soon as they get married, they get term insurance. Notice the sum of their protection is really their insurance plus their investments. Then later on, they may decide to take on a little cash value insurance. But notice that, again, all those three things, they're all combined to be their insurance. And now as you get older, all of a sudden you don't have kids, you're not concerned about your kids and things like, you'll always be concerned about your kids, but you won't have the financial obligation of your child. And you can see those needs continue. So someone said, insurance is never your best investment, and investment is never your best insurance. Do you agree? What do you think? I think I would agree with that too. Just a couple of questions. Insurance is a very complex product. It is very very difficult. So let me just share a few cautions. And there's a place for permanent insurance. But again, and this is mainly on permanent insurance or cash value insurance, but number one, first-year commissions to agents can be 50 to 120% of first-year sales. So if you pay $1,000, that salesman can get $1,500 in commissions. And if it's such a good product, why pay such high commissions? So number two, I know that insurance is very complex. However, if you go to investments, one of the key research has shown that one of the biggest determinants of performance is the cost of your fees. In these investment products, why are the sub-account fees so high? 4 to 5 times normal investment fees on these sub-account products when it's just investments. Assumptions. Payments on cash value products except whole life are based on assumptions, not guarantees. How do you like to buy a product that the company can change after you sign the product? For example, they'll charge you a certain amount for fees now, and if they're not making enough money, they can increase your fees. You've got a certain level of a maximum amount on an index-linked product, and they can change it down to make it lower. So if it's such a good product, why can they change it even after the product is sold? And finally, accountability and transparency. Performance data is very difficult to find for these products. However, anecdotally, it shows that the last 20 years the returns have been slightly better than inflation. So these are just some questions to have. There's a place for cash value insurance. But for students, there's not. Rarely for students, too. So with that introduction, with those cautions, let me turn over to Tyler Vongswad. Tyler took this class about 10 years ago, and he's been so gracious to come back and speak to the class, so I'm appreciative of this time. Whenever I have questions, I always go to Tyler and ask him, and he kind of sets me straight on things. But he's someone you really should know. Big hand for Tyler Vongswad.
Thanks, and thanks, Brian, for having me come. We did a class this morning and talked a little bit about it, and I really do enjoy coming out and speaking. Being where you guys are and sitting in your shoes or your seats, standing in your shoes, I guess I'll sit in my shoes, right? I remember wanting to know and experience, okay, this is school and this is all great, but what does the real world look like, and how does it differ, and how does it compare, and what are the things that it's saying? And I think that's the great thing about Bryan is he brings outside speakers in who are professionals in the different areas that you guys are going to be learning in, to be able to share some real world experience on top of the academic knowledge that he's going through with you.
And they know what they're talking about too.
Oh, and I have, and this is a master's section, right? So I have a good friend who I grew up with. He got his MAC from BYU and then is now a CPA and CFA. And we were talking a few years ago, and we were talking about this class, and he said how impactful it was on him, and of all of the different classes he took, how much this really affected his personal life and financial situation to really get him started on the right habits and base his financial planning on the right principles, so that when he got married and started having kids and was working, that he had a plan in place and a track to run on. Contrast that with probably the average American who does most things by default, doesn't want to deal with their finances, and really isn't quite sure how this credit card thing works, but they know if they swipe it, they get to buy something. Only to realize later that they're $12,000 in credit card debt and have very little savings, and have kind of the average household income, and they're just trying to get things figured out and try to figure out, okay, now that we've built our lifestyle as we have, how do we save money? Because we don't want to cut out our daughter's dance class, or we don't want to cut out this, or we don't want to cut out that, and gee, those piano lessons are so important, and I don't want to move into a smaller home, but they've got to figure out on a fixed income how to then adapt their lifestyle to create savings. And if you build your lifestyle around the principles taught in this class, pay the Lord first, pay yourself second, and then build your budget around for everything else, that's really going to give you a huge head start into life and put you on a very solid track going forward. So today we're going to talk a bit about life insurance and how it fits into the overall framework of a financial plan. And I want to make sure, we have a lot of material that we can go over, but instead of me just rambling up here for too long, I want to make sure that we cover the things that you really want to talk about during our time together today. So, questions that you have about life insurance and about how perhaps it fits into the framework of financial security. Yeah.
So it was brought up earlier, like how do you know if you're paying too much for life insurance or any type of insurance?
All right. Other questions? Yeah.
What types of life insurance are best as you grow older and at different stages of life?
Some of these I'm just kind of scribbling notes down so I remember to come back to them. But okay, so understanding the different types of life insurance and understanding how your situation might change what type of life insurance is best for you at a different point in life. Okay, we'll talk about that for sure. Other questions, things that you guys want to make sure we discuss today? Yeah.
Could we go over the rating system?
Yeah. Financial strength ratings, is that what you're
Yeah, that's
talking
like
about?
an investment.
Okay. Other things we want to discuss today? If you think of any throughout the presentation, let's spend some time there talking about it, and we'll dig a little bit deeper into those different pieces. What do I press here? I'm sorry.
It just, the one that says techies.
This technology didn't exist when I was here. This worked. This is the same system that was here when I was, but everything else a little different. All right. So the objectives today, we're going to understand how does life insurance fit within the framework of financial security? What have church leaders said about life insurance? Which demographics need or want life insurance? How do life insurance companies work? We'll spend a little time talking about that. How much life insurance is needed or wanted by you? And what are the different types of life insurance? And what type is most suitable for you? And what are the considerations to buying life insurance? And so financial security, if you guys were to define financial security, what does that mean for you? How would you define it? Yeah.
I'd say either covering your lifestyle expenses or your liabilities, just being able to live off what you have for a given amount of time.
Okay. So being able to cover your expenses, debt obligations, and just for a certain period of time, whatever that would be. Okay. Other thoughts? Yeah.
I'd say that if anything unexpected happens to me, that my family would be taken care of.
Okay. So not only covering liability obligations and lifestyle expenses, but also be able to prepare a little bit for some emergencies. Okay. So I'm going to write on here an equation, because we're all geeks, right? We all like numbers and equations. So financial security is when your assets and your income are greater than your expenses. If that equation holds true, and it'll continue to hold true, then we have financial security. Right? Sometimes we have expenses that pop up that are a bit higher than we were expecting, and that our income can't cover. And so it's important to set aside some assets to be able to cover those expenses. But on a day-to-day standpoint, our income's going to be covering most of our expenses until we hit retirement, right? And we stop having that earned income, and we're really living off of our assets at that point. So this equation, the numbers that are associated with this is going to change over time. Your assets may not be much right now, but your income potential is huge. If you took the net present value of what your income's going to be over your working career, it's a pretty big number. And so that's the piece that at this stage of life we want to focus on protecting. And so, as well as building assets and keeping expenses low as well, and watching and monitoring those. So there are 3 threats to income that I can think of. You guys think of what those might be?
Government? I'm kidding.
They might increase your expenses, but yes, from an income standpoint, what would stop your income from coming in?
Loss of job.
Loss of job. Okay. What's something else?
Death.
Yeah. Disability and death. Okay. That's it. Outside of those 3, your income will continue. Right? You guys are here today. You're focusing. You're spending a lot of time and money and energy and effort. Way too many sleepless nights focusing on getting yourself in a position where you can generate income, right? Where you have control over, if you do lose your job, you'll be able to get another one. If you want to change careers or do something like that. Again, you're putting yourself in a position where that income in that job security is really up to you at this point. And so you can, again, from a risk standpoint, that's one of those that you assume. Right? You assume that risk of being able to put yourself in a good, strong position. Death and disability, I guess we have control over whether those happen or not, but generally most people don't exercise that control. And so those are a bit more, we have less control over those risks if something were to happen to us. And so generally we'll transfer those risks to an insurance company so that in the event of a disability or in the event of a death, that there's enough assets and enough income that'll be created to help provide the expenses for which you have stewardship over. And again, those will change as you get older, and we'll talk a little bit about that. So, okay, church leaders. I love teaching at BYU because we get to talk about what the church leaders have said and some of the wise counsel they've given. Can I have a volunteer to read this? Yes, please.
Wise financial counselors teach that there are 4 different elements to any good budget. Provision should be made first for basic operating needs such as food, clothing, etc. Second, for home equity. Third, for emergency needs such as savings, health insurance, and life insurance. And fourth, for wise investment in the storage program for the future. May I comment on 2 of these elements? Nothing seems so certain as the unexpected in our lives. With rising medical costs, health insurance is the only way most families can meet serious accident, illness, or maternity costs, particularly those for premature births. Life insurance provides income continuation when the provider prematurely dies. Every family should make provision for proper health and life insurance.
Okay. So again, focusing on creating an asset, something that's going to be able to generate some income and provide in the event someone passes away. And in most recently published, Marvin J. Ashton's One for the Money says, appropriately involve yourself in an insurance program. It is most important to have sufficient medical and adequate life insurance. So, this is great counsel. We as LDS culture sometimes can be an interesting people, right? Peculiar, I guess is the technical word. And sometimes I'll hear, we don't need life insurance because my patriarchal blessing says I'm going to do this, and that's not going to happen until later in life. So we're good for right now, right? Or we're living the commandments, and the Lord will take care of us because of this. So and I'm not. I mean, those are good things, and you should live the commandments, and the Lord will take care of you. But He does it in ways sometimes that we don't necessarily expect, and so we've also been counseled again to be wise with our finances there. So okay, the demographics that need or want life insurance. Here's where you get a little bit technical. So I'm going to read the definition of the economic value of a human life. Yeah.
The monetary amount created by an individual's current and future earnings, or services rendered for dependents or organizations.
Okay. So, as Brian talked about before, if someone passes away, there's no way we're going to replace that person. The good that they're going to do in this life, the impact that they're going to have on people and their families, on their children, But what we can do is help out with the monetary pieces that'll fall from that. And so let's talk a little about some of the economic value of these different situations. So the breadwinner of a family, what's the monetary value there? The salary, right? The income that's coming in that they're bringing in. What about a stay-at-home parent of a family? Is there economic value there?
Yeah.
Okay. What?
Daycare services.
Okay, daycare services. All right. Now, I know my kids are at school right now. My wife's at home. You know, she's just not eating bonbons and watching Hallmark movies. Oh, she might watch some Hallmark movie at some point today, but she doesn't do that all day, right? There's a lot of stuff that she does. And so I remember one year, MSN had some article, and I gave it to her for Mother's Day, and it said the economic value of a stay-at-home parent was like $115,000, right? I mean, because it is the daycare, but it's also the laundry and the dishes and the meal preparation and everything, therapy and counseling, and so many different things that they provide. Yeah.
I mean, if the breadwinner is going to become a stay-at-home parent, then the value is the exact same.
Yeah. Yeah. Very true. Yeah, I've heard it say, you know, people, as we've been talking to people, we say, hey, well, if the kids, you know, lose mom, I don't want them to lose dad too because he's at work. Like, we want to make sure that, you know, dad can be at home, and at least during those, you know, critical years of childhood. So everybody's plan's a little bit different, and that's the nice thing about insurance is you can cover and you can create and design your own plan based on your goals and your needs. Key employee of a business. Anybody own a business in here? Have employees? Sometimes we have that, but right, the cost to replace a key person, it's a lot. They provide a lot of value to the business, and with them gone, it's not just providing their salary, but it's providing someone else's salary to replace them, and the cost and the time that it takes to train and develop that person can be high. So again, there's that partner of a business can be something similar. Let's say that you have two partners in a business, Bill and Susie. And Bill is married to Linda, and Susie is married to Fred. All right, now I forgot the names of the people who were Bill and Susie, right? Bill and Susie, they're partners. They each own the business. It's worth $1 million. They each own, you know, $500,000 of the business. What happens if Susie passes away? Their spouse owns it, right? And does their spouse have the abilities and the wherewithal and the knowledge and the skills to be able to take over and add value to the business like Susie did? Maybe, maybe not. Probably not, right? And so now Bill has this other partner that he's paying 50% of the benefits to and 50% of the profits of the business who's not contributing to the business. How long can that last, right? Maybe Bill's a nice guy, I want to do that for a year or two, but when times get tough, it's going to fall apart. It always does. And so, most of the time it does. And so having a cross-purchase agreement or an entity purchase agreement in place can help create liquidity when it's needed to essentially buy the business from another person. What about a single retired owner of a large estate? What economic, let's say they're 85 years old, right? What economic value do they provide? What happens if they pass away? Let's say their estate's worth $20 million. What happens if they pass away?
Well, the only value is the longer they stay alive, the more they can avoid the estate tax.
Yes, right? So when they pass away,
start giving that away every year, a little bit at a time.
right, which is fine to do if you have an extra couple $100,000. It's difficult to do when you have 20 million and growing, right? And so what happens? They pass away, they're worth 20 million. They get an exclusion of 5.4 from the IRS. They have roughly, $14 million still there. That's going to get taxed. What's the highest tax rate on estate taxes? 40%, right? 40% of 14 million. That's a lot of money. And in a $20 million estate, people generally don't have 20 million sitting in the bank and nothing else, right? It's usually invested in businesses or real estate which may be difficult to sell and liquidate within the time frame that the IRS wants their money. So when does the IRS want their money? They want it within 9 months. They don't want the property, they don't want the businesses, they want cash. So creating a life insurance policy that would generate some cash to cover the IRS so that the kids don't have to do fire sales on the properties can be a huge benefit. All right, does economic value change over time? What do you guys think? Okay, so how does it change? Someone was not in their head. Yeah.
So if you are at the start of your life, when, like, let's say there's a couple that's married and they're like in their late 20s, and the breadwinner has a lot of earning potential for the rest of their life, whereas when they're in their 70s and they're thinking about retiring, they've saved enough for the rest of their life. The need for, if one of them passes on, they're like, great, I have, not great, like they have more assets to help them live the remainder of their life.
Yes. Yeah. And that's absolutely, things will be changing. So as you're young, maybe it's funeral costs, right? I mean, that would be the economic cost if you passed away. As you get older, you get married, you start becoming responsible and having some stewardship over another person. Maybe you buy a house or have some kids, and then you increase in salary, so then you increase your lifestyle, and all these things are kind of increasing this need for life insurance or total protection, right? The investments as time goes on are going to help offset that need for life insurance a little bit, and it'll start to come down to where you may not need life insurance again because the income is provided for, and the expenses are provided for not necessarily the income, but by the assets. And at that point, life insurance is really not necessary. So, say that again.
And it's expensive, so know you're about to die.
Yes, it's very expensive. Yeah, I had a couple in my office the other day. They wanted to have some life insurance because they haven't been good savers, and they were 69 and 70 and wanting to get some life insurance. And it's expensive. All right, how do life insurance companies work? It's really through a concept called risk pooling, which I have some technical analysis up here, which you guys can go through. But essentially, these guys get together, say 10 of these people get together and they say, all right, we're all going to put $1 in the pot, and if anybody dies, they get the $10. Right? And so that's kind of the idea of risk pooling. We have a little bit more details in here. I'm not going to go through this right now. But it essentially says that to a greater scale. Now there is, in these pools, I do want to point out here, life insurance companies create more narrow risk pools, including but not limited to the following factors: current and previous health conditions, family history of health conditions, tobacco or other drug usage, and hobbies or other avocations. So that could be skydiving or bungee jumping or ice climbing or mountain climbing or scuba diving. Any of those things can affect what your premiums look like. And so the other question a lot of people ask us is, okay, let's say I were to pass away tomorrow. What does that look like for my wife? Does she get that money all at once, over time? And it can really be a combination of both. It depends on what you want. So the fastest way you can get it out is really just get a check and have that lump sum dollars. The slowest you can get it out is guaranteed income payments over the span of their life. So they'll get paid, they'll get a paycheck every month for the rest of their life, regardless of how long they live, whether it's another 10 years or whether it's another 80 years, it doesn't matter. And so you can do something in between, though, as well. A lot of times what we'll do is we'll create a certain amount of guaranteed income that matches their basic expense needs. And then beyond that, we'll take extra dollars, and invest them conservatively or in a balanced account, depending on how comfortable they are with the market, how comfortable they are with risk, and then use that to cover kind of the bigger expenses that may come up for other things, kind of those one-time emergencies, or to help keep up with inflation. well and covers some of the other ones. So there's a lot of flexibility in how those benefits can be paid out. Any questions you guys have at this point? Yeah.
Can it transfer twice? So if you died, it goes to your wife, and then she dies. Could it go to children? Or?
Yes. However, are you talking about the income transfer?
Yeah.
You could. You could set up an arrangement that said it's a joint and survivor annuity, essentially. So let's say I pass away, and then my wife says, all right, this income stream I want it guaranteed to last the rest of my life and the rest of my child's life. You could do that as well. And so it's going to last for whoever dies last. All right. I'm gonna pause here. Do people need life insurance? I'm married. I've got 3 kids. My wife, she's educated. She has her degree, her bachelor's degree, but she's not working outside the home. Really, she's working plenty hard inside the home. Do I need life insurance?
Yes.
There's plenty of single mothers that manage somehow, but it's hard.
Okay.
Or fathers.
Yeah. Yeah, there's plenty single parents out there with kids trying to figure it out, right? And I'm going to just play devil's advocate for a second and say we don't need life insurance. People figure it out. There's government programs to help out and do things. I guess the question is, are my kids going to have, and is my wife going to have, a similar lifestyle to what they had if I didn't have life insurance? And at this point, the answer is no. They're not. And if I were to pass away, I would still want them to be able to do all the things I'm planning on doing with them. To be able to, be comfortable, pay off the house, take vacations, reasonable. I want to be reasonable. I don't want to go, hog wild, but and be irresponsible. But I do want to make sure that they still have opportunities, that kids' educations are paid for, and that they're able to serve missions that where my wife would be able to say, hey, a mission was an important thing to Dad. It's your choice, obviously, but if you want to go, here's some money to be able to help cover it. And if that's a way that I can transfer my values and my legacy, passing away early, then that creates an opportunity to be able to fund it financially. And so, again, but it's all a choice. It all depends on what you and your family decide you want to do.
I have a question.
Yes?
So with those factors, I know for like auto insurance, it doesn't go down to the individual. Even though I'm a really safe driver, the fact that I'm a 20-some-odd-year-old male means mine's higher than someone else.
Yes.
In a similar position.
Yes.
For LDS people, we live a pretty clean lifestyle. But does the fact that most other 25, 30-year-olds increase the premium we'll have to pay, or is it more individual?
Yeah, so there are a lot of, again, risk pools that are designed. So for example, alcohol abuse is something that would cause an effect, but alcohol use isn't. Where smoking or any sort of nicotine usage, whether it's the patch or whatever, that would affect rates. So you would get a better rate than someone who smoked really for the last 3 years. Okay. But then it doesn't narrow it down, but it will say, hey, 26-year-old male, and they'll take a look at your height, weight, blood pressure, and cholesterol levels, and ask you a bunch of medical questions and go through the different, hobbies that you have. And so that's how they kind of create those risk pools and create the premiums based on. All right, so how much coverage, right? Everybody heard kind of the talking radio people saying, hey, here's a good rule of thumb about life insurance, or you see them on TV or whatever it is, right? And the standard answer that we often hear, because people always ask, well, how much life insurance should they have, right? And this kind of blanket answer gets thrown out of, about 10 times your income would be appropriate. But I really like this quote here, because I don't think we should take our financial planning so casually, especially if you're educated and armed with the tools to be able to really figure out what's going to be best for your family. Can I have somebody read this? Yeah.
Standard formulas, such as buying coverage equal to 8 to 10 times your annual income, are inadequate shortcuts. Online calculators are apt to tell you to raise your coverage by $1 million even if you already have insurance. The truth is that life insurance is a personal affair. Two couples may earn equal salaries, but it's silly to say that someone with 4 young children should have the same coverage as empty nesters with no mortgage and a substantial retirement fund.
So again, understanding that your situation will change as time goes on, and your insurance needs will change as well along with that. So it's always really important to address this. It's not the most fun conversation that you'll have with your spouse. Like, hey, what should we do if you die? You know, like, I mean, it's just not, it's not something that people want to talk about or address, and but it's important to just kind of keep up with, all right, where are we at right now? What do we want to have happen? What would it take to make that happen? All right, so this is something from the Ensign, and I like it says, life insurance is designed primarily to give financial aid to the immediate family survivors after the insured person's death. Thus, insure the family's breadwinner first, then others if desired as income permits. At a minimum, get enough life insurance to pay for such things such as funeral, taxes, mortgage on the home, car payments, and other debts. The next priority should be to get enough insurance that's supplemented by any government retirement benefits the surviving spouse may be entitled to. There will be sufficient to provide for the family and to make provisions for the children's educations and missions. So, here's just kind of a guideline example. Now, you guys are going to get into a lot of these details with this, the Teaching Tool 29, of all the different ways of calculating insurance needs. Here's the approach that I use with my clients. We take a look at some of the immediate expenses that would happen, funeral costs, debts, and then we take a look at, including mortgage, then we take a look at kind of some of the big future expenses, educations, missions, weddings, and what they want to cover in the event, again, someone passes away there. And then taking a look at and deciding how much income do we want to have come in, and how long do we want that income to last. Now, I want to challenge you a little bit on this, because a lot of times people say, well, I just want to make sure the kids are raised, and then, you know, things are fine. This is a response that we hear somewhat frequently. And so I think, okay, my youngest is 6 right now. She'll be out of the house in another 12 years. We're not letting her back in. So, you know, if I had income for another 12 years, then that would be fine, right? 12 years from now, that puts my wife at age 49. And how easy is it for her, having been out of the workforce for 20 years, to come in, get a competitive salary to provide for herself, and then during the next 15 years, create enough assets to be able to take care of the next 30 years in retirement. And it's just not realistic in the way we want to do that. So again, really take a look and really ask yourself, pose those hard questions to yourself. All right, let's put myself in that situation. Okay, let's say I do pass away. Let's say I do, that income does stop after 12 years. Is that what we want? And if so, go for it. And if not, say, okay, no, we want it to last for this long. And again, figure out what's going to be best for your family. Okay, someone asked previously about the different types of insurance and kind of what's most suitable here. So let's talk about it. There's 2 main categories of insurance. There's a kind that you're essentially buying your insurance. You're putting money into it, and you're going to have it. You're going to have it for the rest of your life. That's a permanent insurance plan, right? There's another type that's called term insurance. It lasts for a certain term. And I think the easiest analogy that we can make is very similar to buying a home versus leasing a home, right? When you buy a home, you're paying more money, certainly up front, to purchase that home, and it's possible that the mortgage payments might be even a little bit higher than maybe a rent payment would for what you're trying to get, right? And in a rental contract or a leasing contract, usually enter it for a certain time period, and when that time period's up, the landlord says, well, we can renew, or you can go away and find something else, right? And sometimes that works out well for you, right? Get out of here. So life insurance kind of works the same way, in that there are pros and cons to each type of plan. So in a permanent insurance plan, it's typically more expensive to get that goes, always, I should say, more expensive than term insurance to get going. Similar to equity in a home, we have cash value in certain permanent insurance policies. You have a bit more control. Your payments can stop. At some point you can pay into that insurance contract, and then you can be done paying while still having all the benefits of the death benefit as well as the cash value. And then there's some tax benefits, again, just like a home where you get to write off the interest. In a life insurance plan, the cash value grows tax deferred, and there's ways that you can strategically pull it out tax free, but you do need to be careful because it could come out as, the growth could come out as income tax for you. So again, just be careful of how things are structured there. In a term insurance plan, again, it's temporary. You choose a certain term. It's generally less expensive. Now, the difference between renting and buying, maybe 10 to 20% difference in housing. In insurance, it can be about 10 to 20 times different. So the permanent insurance contract is much more expensive than a term insurance contract. Why? From an insurance company standpoint, we're saying, all right, here's this term insurance plan. You're probably not ever going to use it because you're probably not going to die within this term. So here it is for a little bit amount of money. On a permanent insurance contract, they're saying, all right, we know we're going to pay this claim out. I don't know if it's going to be a year from now, 5 years from now, 10 years from now, or 80 years from now, but at some point we're going to pay out this death claim. So we need to set money aside to be able to do that. Hence why it's a lot more expensive in that type of plan. So which type is better, right? That's always the question that we have. Because you guys are wise, you always understand that when anyone asks what's better, say, well, it depends, right? That's a good standard answer. So it really depends on your goals and your situation. So remember that with life insurance, as with any financial decision, financial security is the goal, not just having life insurance. It's not a check box like, oh, hey, we got some life insurance, check. We don't need to think about that anymore, right? We want to assess, at least on an annual basis, to make sure if it makes sense or not. We're going to 40 is when we want to stop the presentation. So, okay. The other goal too is, as Brian talked about before, insurance is never your best investment. Investments are never your best insurance. So make sure that when it comes to insurance, you're focusing on the death benefit first, and that's the primary goal. And then secondarily, that if it has other benefits that allow you to access cash prior to passing away, then that's kind of a secondary goal to the death benefit. Duration and ability to pay premiums. These contracts have a lot of upfront costs in them, and so if you put money into them and you decide, I don't really want to do that, a couple years later, you could lose most or all of your money that you've put into it. So just like really with any investment as well, you don't want to be invested in something that's not appropriate for you. You don't want to have an insurance contract that's not appropriate for you, because if you pull out at the wrong time, it could be bad in either scenario. So make sure that if you are ever looking at particularly permanent insurance, that you understand you can say, all right, I'm committing to this premium, I can make this premium payment year after year after year, and I'm comfortable with it. All right, so and we're going to dig a little bit deeper into the different types of permanent insurance, but different types of term insurance, let's go through this. Here's an example of a level term insurance premium and an annually renewable term insurance premium. The premium is essentially the cost that you're paying for the coverage. So one option would be, this is based on $1 million benefit for a 25-year-old man.
Later doesn't work.
All right. So, I'm not going to jump the point. On that blue line there, that would be for a 20-year level premium term insurance contract. You pay the same premium year after year after year for 20 years, and if you pass away during that point, the insurance company pays out your beneficiary $1 million, and if you don't, then the policy is over. The other option would be on an annual renewable, which would be that term 80. It goes until age 80, but it gets more expensive as your chances of dying increase. All right, and so this is the annual renewable is that type of term insurance that I have on myself. Because met with a lot of different people, a lot of different stages of their life. And those who are younger tend to have a lot more change happening in their life than those who are older, right? They're having more kids and they're buying a home, they're getting that bigger salary and they're adjusting their lifestyle because of it, and all those things are putting upward pressure on their insurance needs. And so being able to pay less now for that coverage, knowing that they're going to be increasing that coverage as time goes on and as their situation changes, can make a lot of sense. One, from a financial standpoint, and then two, from an underwriting standpoint. We'll talk about that in just a sec. Yeah.
What increments can you buy insurance in, and could you achieve some of the same effect by having multiple policies that you sort of step up?
Yeah. So you can do a kind of a laddering effect in those policies. So as you're getting older, you start laddering that insurance on top of each other, and then as those insurances start to expire, they kind of ladder off on in the same vein. And there's all different types. I think there's some companies out there that will just let you choose. Like, you want a 7-year plan, okay, here you go. But generally what you'll mainly see out there is a 10-year, a 20-year, or a 30-year plan. Someone else had their hand up over here.
Same question.
Okay.
I didn't like what amounts, I guess, like 250, 500, or...
You choose. Yeah, you choose. You have to be approved for the policy, and life insurance companies essentially will take a look at your assets and your income to see if you qualify. Because as Bryan said, life insurance company doesn't want you worth more dead than alive, right? Because that creates a moral hazard that they don't want to deal with. So, and you might not want to deal with either. So, yeah.
With your annually renewable, how often do you have to have a medical? Is that something that's annually done?
Yeah. No. So once you lock into that, you could go all the way to age 80 without having a medical.
So just 25, maybe medical.
Yep, and you could just sit on that contract. But it gets more expensive as you get older. So we're going to take a look at the next slide. Right. So after that 20-year time period is up, you say, all right, we still want to have insurance. And who applies for the insurance policy? It's not a trick question.
I do.
You do, right? Who decides whether you're approved or not?
You do.
Not me, but the insurance company does, right? The insurance company decides whether or not you can get approved, and again, based on all of those different factors that we've talked about before. So if you've locked into one where you can sit on until you're 80, well, you can choose, hey, I want to maybe apply for this new plan, but if I don't get approved for it, at least I have that. So again, another reason why I have this one on the yellow line is I'll probably keep it until age, between somewhere in the 40s or 50s, and then I'll probably switch over to a level premium plan, which at the best rate, I'm on this blue line here. If I'm not as fit as I am now, then I may be on this line or the green line, or if I have some other health issues, then I may be on that top line up there. So, which could be very expensive to have insurance. All right. So again, there's kind of pros and cons to the cost structure of each policy and plan and how you want to structure it. Here are some types, I think you asked that, right, of different coverages, 10-year, 20-year, 30-year. There's an annual renewable. There's also, in addition, a mortgage life insurance. Anybody own a home in here? Okay, right? You buy that home, and then what comes in the mail? About 33 different offers about life insurance, how if you pass away, your mortgage can be paid off, and everything. There's also an accidental death and dismemberment insurance policy, which says if you die due to an accident or something gets cut off, then you can have some benefits or some additional benefits associated with that. There are also riders. A rider is a piece on the policy that gives you an extra benefit. Sometimes you pay for them, sometimes they're part of the policy. So just trying to understand what those look like. Convertibility is the ability to change from a term insurance plan to a permanent insurance plan without any medical underwriting, right? So without having to go through and get approved for a policy. I have a client who has MS, right? She locked in her term insurance. She went to go get term insurance today. It'd be really expensive. but she can convert over from the term to the permanent insurance, and she gets the best rates because that's what she got on her term insurance. A waiver of premium says if you become disabled, the insurance company can waive the premium on the policy, right? Again, we have to just kind of throw ourselves in these situations. If I'm a breadwinner of a family and we're kind of just in the midst of life and something happens to me and I can't provide an income, I'm going to be focused on keeping food on the table and keeping us in our house with the lights on, right? We're going to, vacations might be out, extra whatever, insurance. If that's going to get cut, that's going to get cut before me eating, and my family eating. So that's why this exists. In the event of a disability, the company can cover the premiums. Did I see a hand up here? Accidental death and dismemberment we talked about. Additional purchase benefit can be something that allows you to purchase additional amounts of insurance without going through medical underwriting. This is what I have on a policy for my kids. They can purchase up to an additional $1,050,000 without ever having to go through any sort of underwriting questions. So my son, he's just a ball of energy, and if he ends up being a skydive instructor, I wouldn't be completely surprised. But if he's going to try to protect his family with a life insurance policy while he's up skydiving, they're not going to cover it, right? If he's going that often and that much. So this will allow him, not that I want him to be a skydive instructor, but this would allow him, regardless of his health or his hobbies, to be able to get coverage at the best rates. Cost of living adjustment, and that's what I have all. But cost of living adjustment is just keeping up with inflation, and child benefits. Sometimes you can tack those onto a policy, and it'll say, all your kids are covered for $10,000, and it's going to be a few dollars a month to do that. So again, those are riders that you can take a look at and see if they're available on the policies. All right, let's talk for a bit about some different types of permanent insurance. So, does anybody know much about permanent insurance? Okay, so let's talk about whole life first. Whole life, when insurance started back in the 1800s, that's, I guess in its formal structure, that's the insurance that was around. You pay money into a policy, and you keep paying that, and then when you pass away, you get a bigger benefit back. And there weren't all these other variations that exist today. And so whole life is one that's built on some guarantees. There's guaranteed premiums. So as long as you make your premium payment, you have the insurance coverage. Also, there's guaranteed growth in the cash value. So it's guaranteed to grow by a certain amount each year. Now, it can grow faster than that, but it's at least guaranteed to grow, meaning it never goes backwards. In a universal life contract, to contrast that, it works a little bit differently. The premiums aren't guaranteed. In fact, you have some flexibility. You can choose whether or not you want to make a premium payment that year, and you can choose what you want that premium payment to be. Now, understanding if you pay too little, you might get a letter in the mail saying, all right, your policy's not going to be around. But here's, I think, an interesting example. Anybody know where interest rates were in the early 80s?
15, 17.
Okay. Yeah, double digits, right? And if you're assuming that your cash value is going to grow by double-digit rates, and then your cash value, because interest rates drop, is not growing by 11, 12, 13%, but it's growing by 2 or 3%, then that can have an effect on what the policy is, because the death benefit's not guaranteed necessarily in a universal life contract, neither are the premiums. So if you're supposed to pay $1,000 a year, and you're supposed to get 12% on that growth, and then a couple decades go by, you've paid $1,000 a year, but instead of getting 12%, you're getting 3%. Well, that $1,000 may not be enough to sustain the contract. If that's the case, again, you may be in your late 50s, get a letter in the mail, which is going to happen to some of our clients, and they see this policy that they picked up 20 years ago, and it's saying, all right, there's no more cash value in this because all the cash value is gone to cover the insurance costs, and instead of paying $1,000 a month, a year, excuse me, you need to pay $4,000 this year if you want to keep the coverage. Next year, it might be $4,500. Okay? And so people don't like those letters. I've learned from experience. But universal life can be great for someone who's going to really, they need that flexibility of payments, and they're wanting to put a lot more money into the contract at different times. That can be a little bit more flexible way. Again, we just need to be able to use it properly. There are some other variations to these as well, just variable life, where the cash value, it's not based on guarantees, it's not based on current interest rates, but it's based on what the underlying sub-accounts are doing. So, and those sub-accounts are similar to mutual funds in that they're invested in the market. So that can go up, that can go down, just depending on how you're invested. And there's this, there's all these new, every couple of decades the industry comes out with kind of this latest and greatest. And I don't know that they're ever greatest, but they're certainly the latest ideas that come out there. And that's this equity index, which is kind of the craze of or the flavor of the day, which says ideally, and in pitch, you can get upside market potential with zero downside risk. You can never get less than 0%, but you can participate in market upswings, and every company, every product has a little bit different cap. And so they might say you can participate in the market up to 14%, or up to 12%, or up to 8%, and whatever you sign up for, as Brian said before, they can change. And I've seen contracts like that where clients will come in, they'll bring these things that they purchased a few years ago, and we're looking at the annual statements, and the cap was 14% one year, and then it was 12% the next, and then it was 10% the next, and then the spread or the cost in there was 5%. So if the market did 10%, then they could get 5%. But if the market did 8, then they'd get 3, and if the market did 5, they'd get 0. But if the market went negative by 20, they would still get 0. So there's all of these different variations of these things. I'd like to see these things go for another couple decades and see what they actually do. My experience with them hasn't been favorable thus far, but I think there can be a place for them. Yeah.
And it's just interesting. Saturday I was working in the yard and I turned on the radio and listening to this one guy. He calls it a strategic rollout. They want you to take all your money out of your 401ks and your IRAs and buy index-linked, universal life insurance. And it just really frustrates me.
Yeah.
Because, and the reason they're doing it is not because it's a good deal for the insurance consumer, it's because he makes a huge commission on this.
Mm-hmm.
So just be very careful.
Yeah, you really do. Particularly those, they have some similar to market exposure, but they're not securities, so you don't have to be securities licensed to sell them. And so there's a lot more people who are, maybe they're not securities licensed, but they still feel like they can offer those products. They're very complicated and very misunderstood, not only by consumers, but by the sales reps themselves, which I found.
I've got an advertisement where it says one product, millions in commissions.
Yeah.
So this is what they're sending this to all the insurance people. You just sell this one product and you'll make millions in commission. It's not that it's a good product for the consumer, but it's a good product for the salesman.
Yeah, we need to be real careful there. So I have issued here. I'm not going to go through this right now, but you guys can have these slides, and it talks about some of the key features and when to use term insurance, whole life insurance, and universal life insurance, and then again some of those variations that we talked about as well. Are usually built off of a whole life chassis or a universal life chassis. Most of them are built off of a universal life chassis. It's just the difference being how the cash value can grow and or shrink depending on what's going on in the market. All right, so some other considerations in buying insurance. I want to check to see if we covered the questions. All right, so we talked about tax investment. Okay. So know what you want to achieve for financial security and find a life insurance policy that fits it. Right? Don't just go out shopping for life insurance. insurance, right? You're going to find 87 different articles, and they're all going to say different things. So know what you want, and then find a policy that fits it. Understand the company's financial strength ratings. Someone asked about how do we find that out, right? And I'll show you just a minute here. Find a licensed professional you're comfortable with. Compare policies not just on price, but on benefits. And this is where, how do you know if you're paying too much for a policy? The industry in general they all kind of go off of their own programs and policies and pricing models and everything. They are similar, right? I don't think you're going to get completely. There's some variation between depending on how efficient the company is, but I don't think that you're going to find a reputable company that's going to have an outlandish cost on their policy. Again, you're going to find small variations from one company to another, and so it's important to kind of take a look at those. Because some companies are more efficient than others are. But really take a look at what's underlying, what's the financial strength backing the company, and what are the benefits that are structured underneath. So here are a few different rating agencies and some links to those. You can go on there and see, go on their website, you can look up the financial services life insurance company that you may be interested in and take a look at what their financial strength ratings are. And so those are 4 of them. Not all of them rate all companies. Generally, once they get to a certain size, they're rated by more and more companies. But there are about 4 companies in the industry that have the highest financial strength ratings available from the 4 rating agencies. And so those are obviously solid ones to go with. There's also an aggregate consumer complaints report where you can go on with the National Association of Insurance Commissioners and see kind of how many complaints are registered against the company as well. And that can give you a little bit of an idea as you're trying to narrow things down. I love, and this is probably one of the most recent things that I've heard, at least over the pulpit, about financial advice. I guess I'm going to volunteer to read this.
Consideration should also be given to investing wisely with responsible and established financial institutions. We are also concerned that there are those who use relationships of trust to promote risky or even fraudulent investment in business schemes. While all investments carry an element of risk, that risk can be managed by following sound and prudent financial principles. First, avoid unnecessary debt, especially consumer debt. Second, before investing, seek advice from a qualified and licensed financial advisor. And third, be wise.
We live in an area where this happens far too much. And I don't think it's because of people who you trust acting viciously, for the most part, at least. Sometimes it's like that, but I don't think it's that for the most part. I just think they're acting ignorantly. They may be trying to put you into something that their manager told them was really awesome for these 17 different reasons, right? And so we just need to be careful, we need to be educated, we need to be wise with who we're working with and how we're working with them, and understanding what our goals are, what we really want to accomplish before meeting with the person. There are some other slides, just some things to watch out for. I'm not going to go over this right now. You can email me if you guys have additional questions, but we wanted to spend a few minutes talking, or I guess having you guys write down some of the things that you learned, what you're going to implement, and then we're going to share those.
Yeah, what are your takeaways? Open your digital dialogue box or your place where you take your notes. Right.
You guys have about 2 more minutes to write some stuff down. Chat. watch out for these things. Yeah. That's pretty bad. Yeah. Here are the new provisions of what you know, done so well. And here's the thing, people in those contracts, most of them, because they were so risk averse, that they'd rather just go with guaranteed growth than even take the chance of getting potentially paid, knowing that they might be zero. So they'd rather just go with and then those products can very costs associated with it because of that. Just maybe last year. Maybe last year, not this year. All right. So tell me, can I have a couple volunteers, or should we pick on people? All right. Can I have a couple volunteers of some things you guys learned today? Yeah.
So mine was, because I actually looked into life insurance a little, and I got so confused because all the benefits, and so I thought rather than decide on a plan because benefits, look at the future and what my needs are, and have that help me decide.
Right.
Because there's so many options.
Yep. Absolutely. And if you go in with those and talk with a financial advisor or an insurance agent, say these are my goals, this is what I really want to accomplish. Hopefully they'll challenge you on those. They won't just say, okay, here we go. You know, hopefully they'll say, hey, you think about this and that, and give you some other just points to think about, and then they should be able to design a plan fairly easily that's going to match. There's so many products that we have available to us that you know, designing a plan that's going to meet those goals should be fairly easy. Unless you say, you know, hey, you've got $1, turn it into 20, you've got a year, right? Yeah.
I liked how you talked about not just doing like a multiple of your income when deciding on how much life insurance you need. Is that, you know, there's so many different factors that you need to look at.
Yeah, absolutely. Yeah, it really depends, and they'll change too, right? Those factors that are applicable to you now will be different 5 years from now, and different again 50 years from now. We go one more. Yeah.
Just be very cautious with permanent life insurance, especially now, at this point in our lives. Term is probably the best way to go.
Yeah, absolutely. So permanent insurance can have a place. I would say the majority of conversations that we're having people about with the average age at which that we're having those conversations is in 40s to 50s. They still have some time to make it work, but they're also a bit more financially secure and have some additional dollars to put towards it, and they're putting towards their IRAs and their 401ks, and taking advantage of the company match, and letting themselves be aggressive where it's appropriate to be aggressive.
Tyler, what's your takeaway from today?
My takeaway is that I see a bunch of bright young faces. That you guys, it's fun, and it's tough during school. It gets more fun, I promise. You get out and have fun with your lives, enjoy them, be purposeful, and make right decisions.
And let me just share my last takeaway too. You know, the purpose of insurance is really to buy security for you and your family, security, life, health, auto. We should never forget the source of our final security, which is our safety, the captain of our lives.